So a bit of positive news coming through from Greece, because we know that that debt swap has, of course, occurred last week. And then we heard news on the CDS front, and then a bit of negative news coming through from China. So it is a balancing act, it seems, at this point.
Yes, absolutely. But the one thing we shouldn't forget is that in terms of potential hurdles for market risk appetite, everyone was, of course, looking at that Greek debt restructuring, looking at the potential outcome of that. Given that we've had that news and we think that the full impact has yet to feed through into market behavior, this, of course, does set a positive tone overall. The key question now, of course, is, are we going to see concerns shifting to the rest of the euro area? And are we going to see those Chinese growth concerns becoming that little bit more important in terms of influencing overall sentiment?
Razia, when you look at what has been happening even in the US, I mean, we've got unemployment sitting at 8.3%, non-farm payrolls coming through at a slightly better level. So it seems very undivided whether we will see any form of stimulus announced by Ben Bernanke tomorrow. How do you think markets will respond to a lot of the news? And are emerging markets also just being very cautious ahead of the announcement tomorrow?
Sure. Well, for markets overall, of course, given the recent run of US economic data and the interpretation that this has been pretty good, there aren't widespread expectations of further stimulus being announced in the US as early as this week. Markets have very little in the way of expectation going into the FOMC meeting, and therefore we think that the potential for disappointment is likely to be fairly limited. Of course, for emerging markets, there is, of course, a much broader situation at work here. It isn't just the near-term impact, but if we do see this healthy bounce back in risk appetite overall, and given the expectation that emerging market growth continues to be relatively strong, that some of those external threats might be receding, that adds even more impetus to the appetite that we're seeing for emerging market assets.
Well, let's just take a look at the likes of Kenya and Nigeria. I know you've just come back from a roadshow in those regions. What kind of appetite are you seeing on the ground, Razia, when it comes to foreigners looking for exposure to emerging markets, but emerging markets within Africa?
Well, what we've been focusing on recently, of course, is the appetite that we see from offshore investors based in the US, based in Europe, and how now they are looking at Africa that much more closely. Of course, there had long been this resurgence, if you like, of interest in frontier Africa. What's really driving it in a very strong way was the extent of monetary tightening that we saw in East Africa last year in reaction to the drought. The kind of yields that you see in Nigeria today, again, a consequence of last year's monetary tightening. Now, for investors looking very closely at these regions, of course, these kind of yields are considered to be very favorable. There is a realization that they're not necessarily going to be in place for very long. And so I think we're going to see a great deal of change in terms of investor positioning ahead of the expected rally in some of these markets. To some extent, in East Africa, we've seen that rally in the Ugandan bond market. Everyone looking very closely at Kenya now as possibly the big economy, the economy that's going to start easing interest rates significantly, and that's making a big difference to overall market expectations.
Well, that's an interesting point, Razia, because, I mean, you look at Uganda, for example. We know that inflation is quite high. They're double-digit numbers that we're seeing coming through. We've got pretty much the same scenario playing out in Kenya, and it really all depends on the agricultural sector and what we see on the food and fuel front. Is this a point that investors take into consideration when investing within these markets?
I think what investors are looking at from the perspective of the East African region is that the kind of stresses that we saw last year, what pressured inflation to the kind of highs that we saw, not just in Uganda and Kenya, but across the region, Tanzania, Ethiopia, just about all the East African markets saw the same pressure. That was the result of perhaps a 1 in 60-year type drought in terms of its severity. It creates a very high base. We've already seen the peak in inflation. We're starting to see inflation coming down. There has been more encouraging news with rainfall. On that basis, we would have to have an extraordinarily negative run of luck in terms of not seeing a turnaround in the inflation data. Our own forecast, of course, is that in both economies, Kenya and Uganda, we will be in single digits by the end of the year in terms of inflation.
All right, let's just take a look at what's happening in South Africa and with regards to foreign flows. It seems that that is starting to dry up, and it seems that other emerging markets are starting to gain the appetite and attraction of a lot of foreigners out there, Brazil being one of them, because we just saw the central bank intervening to try and weaken their currency. How do you see this playing out? It seems that emerging markets are all fighting for liquidity that is emanating from the likes of the Eurozone and still from the US.
Well, yes, and I guess in the case of some countries, they're more inviting of that external liquidity than in others. The difficulty, of course, with South Africa is that in terms of its inflation cycle, its tightening cycle, things are rather at odds with what we've seen everywhere else. In the emerging markets that saw considerable economic strength in the wake of the crisis, there had been significant tightening. As the inflation cycles change, as that turns around, there'll be scope for easing. Of course, in the case of South Africa, there hasn't been any tightening since the crisis. The global environment and the growth environment domestically didn't necessarily necessitate that kind of tightening, and so South Africa may well be seen in a slightly different light. However, if we do see a big resurgence in risk appetite, it may be the case that all emerging markets, regardless of where they are at this particular point in terms of the overall interest rate cycle, they are likely to benefit.